Hi, my name is Hillary Sunderland, and I'm the Chief Investment Officer at Beacon Wealth Consultants. And this is your March 2020 Market Volatility Update. Well, just 2 weeks ago, I showed you this chart in my market commentary and stated that although we had a nice rebound after a big drop throughout the end of February, we were likely to go another leg lower. And we certainly have, as shown here. Wall Street's plunge has been historic. In the longest ever bull market for stocks ended last week, just days after marking its 11th anniversary. We're now in a bear market, which is defined as a drop of at least 20% from recent highs and are trading near lows set in December of 2018, effectively erasing all of last year's gains in the S&P 500. And the swiftness of this decline has been historic. I wanted to put this into some context for you. Historically, the average number of days from a peak in the market to the beginning of a bear market is 255 trading days, and the median is 156 days. So usually this is a much longer, drawn-out affair over months. And even the fastest plunge in history before this, which actually occurred in 1929, now the second fastest plunge in history, took only 36 trading days. This was even faster than that. In 2020, the plunge to the start of the bear market took just 16 trading days. So as you can see from these numbers, there wasn't much time to analyze the situation and reposition portfolios for volatility, but this is exactly why we maintain globally diversified portfolios throughout the market cycle for such a time as this. You never know when a shock may occur or how much time you'll have to adjust portfolios as a result of it. And so that is why we maintain globally diversified portfolios that are built to perform well in a range of market environments and economic scenarios. Well, it doesn't happen often that a single event or shock could so quickly alter our view of the global economy and impact markets as much as we've seen over the last couple of weeks with the global spread of the coronavirus. We have seen levels of volatility like this before. Now, this volatility in particular is getting quite extended, but similar levels of volatility we've seen occurred in September 11th, 2001, the Russian default long-term capital management crisis in 1998, and certainly the global financial crisis of 2008, 2009. Those are periods of panic and uncertainty, but we got through them. And when we get through the worst and the dust settled, there were plenty of opportunities, and we do believe that it will be the same this time around as well. There are really three major issues going on at this juncture. First, what we have going on is there's a supply shock. A supply shock occurs when there is a disruption in the normal supply of any given product, and COVID-19 put major stress on global supply chains and factories around the globe, with factories and offices closing to prevent the spread of the virus. So you have a supply shock to start with, and this has been combined with a demand shock. As you all know, COVID-19 is now rapidly spreading around the globe, creating a demand shock. And I've covered it quite extensively in my previous two market updates. I'm not going to get into the specifics of the outbreak at this point. I'm sure that all of you are well aware of the outbreak and the concerns on that front. But to summarize what I mean by demand shock here, demand for travel, restaurants, airlines, etc., has completely dried up, representing a shock to expected earnings for companies around the globe. So if that weren't enough, a simultaneous supply and demand shock, it's also being combined with a supply shock in oil, which is what really hit the market starting last week. Last week, Saudi Arabia and Russia decided to flood the market with oil. They are upset with U.S. shale producers and all of the oil we are now producing domestically. And this flooding of the market with oil has led to a substantial decline in the price of crude oil, which is shown here. We've fallen from just above $60 per barrel at the end of 2019 to just under $27 a barrel today, which is a decline of 55%. And today, this chart was done yesterday, today oil actually took another leg lower and overnight, and we're actually at a 17-year low as the markets are opening today in the price of oil. So this substantial decline in the price of oil has wreaked havoc on stocks in the energy sector and on high-yield bonds in particular. High-yield bonds have a lot of exposure to energy names, and so you're seeing some distress in the credit markets as a result as well. So combined, these events increase the probability of a deflationary shock. Remember, deflation occurs whenever the general level of prices in the economy decrease over time. So one of the things you might be thinking of, well, if the general level of prices is decreasing, why is that so bad for the economy? Why does that create potential hazard? And it's really because deflation is one of the things that central banks like the Federal Reserve try to avoid. So when you have deflation, just think about it for yourself. If you want to buy, say you want to buy a car, and right now you have the money for it, but in a few months you think the price of the car will be cheaper, what's the rational person to do? Well, a rational person would save their money, wait for the price to drop, and then buy it after the price drops. So when you have deflation, when you have general levels of prices in the economy falling, what happens is that people tend to hoard money instead of spend it, because if they just wait a little bit, what they're going to buy is going to be cheaper. So because of that, economic production slows. Because production is slowing and there's less demand for goods and services, companies reduce their workforce. That leads to an increase in unemployment rate, which leads to consumers and businesses defaulting on debt, which just exacerbates the cycle over and over again. So deflation is a very concerning thing in an economy. It's worse than inflation on many fronts. And so this collapse in the price of oil has increased the probability of a deflationary scenario. And that's why we're seeing the Fed acting so aggressively. When the Fed cuts interest rates, this makes saving less attractive to people, because why put money in a savings account when you're earning 0% interest or even negative interest rates abroad? And that encourages them to spend money to prop up the economy, because consumer spending accounts for about 70% of our gross domestic product domestically. So we have all this going on in the background. What does that actually mean for the markets and your money? What are we seeing in the markets at this point? Well, across all geographies, we've seen broad-based indiscriminate selling that's been driven by risk reduction. And this has been especially painful for investors in passive index funds, because they own companies without any regard to their underlying fundamentals. If you own the S&P 500 index, you own the casinos, the restaurants, the cruise lines, the airlines, etc. And so one of the things we are seeing is that active managers are shining during this downturn because of their ability to buy good companies, and they've been able to scoop up plenty of opportunities for going forward. So that's one of the nice things about the downturn, is that because we're active managers, that's when this is the time period when active managers do tend to shine. The collapse in oil prices will likely continue to put incremental pressure on parts of the corporate bond market and on the industrial space. So we're watching that closely. And the odds of a recession in the US, Europe, and Japan have increased materially. When you decimate the restaurant industry, the travel industry, the hotel industry, the airline industry, etc., you're obviously going to take a huge divot out of economic activity. And because of that, the odds of recession have increased. So on that front, we expect global growth estimates to be revised downward. We expect supply chain disruptions from the shutdowns will continue to impact manufacturing, which is just starting to recover. And more importantly, the consumer and services will be impacted. The market has reacted very strongly because these three disruptions to the global economy, the supply shock, the demand shock, and then the collapse in the price of oil, all converging together at the same time, necessitated an immediate repricing of the market. Now, that probably sounded very negative. Let's talk about what are the good things that we're seeing and watching. Well, first, we expect central banks, such as the Federal Reserve, to continue to step in and help support the market. We've seen multiple countries cut interest rates in response to the slowdown and some of the market instability and volatility. This past Sunday, March 15th, the Federal Reserve slashed its benchmark interest rate to near zero and launched a bond buying program, both Treasury securities and mortgage-backed securities. And that was its second emergency interest rate cut in a week to try to stem the fallout from this coronavirus shock. Yesterday, the Fed continued its efforts to shore up the economy by opening credit facilities, so looking at ways to help small business owners stay propped up in this type of economic scenario here. We're also seeing actions on the fiscal side. Remember, fiscal policy is the means by which a government adjusts its spending levels and tax rates to influence a nation's economy. So some of the things we're looking at here and some of the things happening abroad, uh, governments are looking at getting cash in the hands of people, extending lending to small businesses, stopping interest rates on student loans. These are just some of the ways the government is looking to pump money into the economy to shore it up. And so you have both the central bank, which is the Federal Reserve, and the government through fiscal policy working very, very aggressively to stem the fallout from this breakout. And so when we do start to see a decline in the number of coronavirus cases, we should be well positioned for a rebound in the economy. So the question everybody really is watching to have answered is this: do I think that the worst is behind us in terms of the recent market volatility? And unfortunately, I don't think that the worst is behind us yet, because the worst probably won't be behind us until the rate of new infections across all geographies slows. The rate of new infections across the globe is the ultimate determinant that the worst is behind us. Markets hate uncertainty, and this calls for a lot of uncertainty because it's something completely out of our control. One of the things that you can do, though, to try to help stem this is, if at all possible, self-quarantine to help flatten the curve. With social distancing and extreme protective measures, we can, as a community, come together to fight this off and avoid overloading our healthcare system. So on the right-hand side of this chart here, I have a chart from the Centers for Disease Control with protective measures. So with these extreme quarantines that are being done around the globe, with people washing their hands and practicing social distancing, we can slow the spread of the coronavirus so that our healthcare system continues to act below capacity, which is shown by that red dotted line there. Without protective measures being implemented quickly, what could happen is, because about 20% of people who contract COVID-19 require some sort of intensive treatment, it would completely overwhelm our healthcare system, exacerbate the time it'll take to contain the virus, and also make the economic fallout much, much worse. And we're seeing that in Italy. They took quite a bit of time to enact protective measures, and they are having a very difficult time trying to prevent the spread of COVID-19, and the mortality rate in Italy is much higher than in the rest of the world because of that. So our government has taken extreme measures to try to stop the spread of this virus, and the faster the virus can be stopped from spreading, and the less we overwhelm the healthcare system, the less of an economic fallout we will have from this health scare. The other thing you can do, besides coming together as a community to really help stop the spread of COVID-19, is remain committed to your financial plan that was made during more rational times. And don't panic about your investments. We're already taking care of things for you, and we're in this with you. All of our portfolio managers, including myself, are invested in the same portfolios that you have access to through our company. So we also know what you're going through when you look at your account, but I don't want you to panic at this time, because typically what happens is that when we make decisions based on emotions, and especially negative emotions, they aren't the ones that we look back on fondly. And this is very true when it comes to investing. This chart shows the emotional life cycle of investors. And when there is euphoria in the markets, which is characterized by greed, people forget about managing risk. And this is what we saw just a few weeks ago. Mid-February, we were hitting all-time highs in the markets. What we were seeing is people wanted to be more aggressive with their portfolios. They hated seeing laggards in their portfolios, those positions that truly diversify you for times such as this. And people forget about managing risk. But we have a disciplined process where we manage risk across all market scenarios to try to help stem a fallout from economic shocks such as this. So when you start to go through a bear market, which is what the rest of this shows, you start with feelings of anxiety and then denial that the market is falling, fear and desperation, to around the point where we probably all are now, where there is just panic and capitulation in the markets, where you're looking at things saying, I hate stocks, get me out, why did I ever invest? It is at those times that you have the most opportunity in the markets. And so I would just encourage you that when you are the most fearful, that's when you have the most opportunity. So don't let your emotions right now change your entire financial future. Because at Beacon Wealth, we're already doing what we need to do to help your portfolios get through this challenging market environment. And I wanted to walk that through you. Um, I wanted to walk through that quickly with you today. So while there's a lot of fear and uncertainty in the market right now, we are maintaining our discipline of managing throughout the market cycle as we've done for the last 20 years. Given what we've seen in the economy and with the accommodated Federal Reserve lowering interest rates, or with the accommodated Federal Reserve, we entered 2020 with reduced risk in our portfolios. And I wanted to give you a few examples of this. So in our strategic portfolios, such as those of you who are in our mutual fund ETF program, our Kingdom K or Kingdom B portfolios, UMAs, we increased the quality of our fixed income positions in late 2019. And this included things such as allocating to managers with very little exposure to corporate bonds and high yield bonds, which we viewed at that time as having some excess risk. And those are the parts of the fixed income market that have really come under pressure over the last week. And so increasing our focus into those types of managers has really helped stem a lot of the fallout within your portfolios. And we also tilted the equity portion of the portfolio toward managers that tend to invest in higher quality stocks with very strong balance sheets. So while we are witnessing indiscriminate selling during the last 2 weeks, the companies that we are focusing on investing in are companies that are more likely to weather the storm long term because they have the financial capability of coming out through the other side of this. We also added an allocation to alternative investments in the portfolios. Alternative investments offer uncorrelated returns to both the equity and fixed income markets. The alternative fund that we're using in most of our portfolios has captured only 1/3 of the downside of the equity markets. And the other one that we use in our absolute return oriented strategies is actually up over 4.5% year to date. So both of these alternative funds that I'm talking about here, both of these are funds that our clients were questioning last year. You didn't like to own them last year because they weren't keeping up with the very strong market because they weren't designed to. But we had them in the portfolio for a time like this, where when you see massive drawdowns over a short period of time, these are the types of investments that buffer your portfolio. And so those have already been in your portfolio for this market tumult that we've had so far this year. In a more tactical portfolio, so that would be investors in our core satellite models. Remember that core satellite is a trend following strategy based on relative strength. So it's not designed to get out at a market top, and it's not designed to get back in at the bottom. It's designed so that we'll get out after the markets have peaked and start to trend down, and then it'll get back in after the markets have bottomed and have started to trend back up. And remember, this was the quickest bear market in history. So we did take that first leg down because this is a lag in terms of when we will get out, but then we went risk off at the beginning of March. And so a lot of this drawdown we've seen over the last 2.5 weeks, we already had a good portion of the portfolio in cash. We have a significant allocation to cash that we will be ready to redeploy once the markets stabilize and start the upward trend once again. So this has been very good for you. You're already very defensive in your portfolios, have a very large allocation to cash. And additionally, in that we also, through the strategy, through our relative strength methodology, we invest in sectors that are exhibiting the strongest relative strength. And so because of that, we're already positioned in more defensive sectors than we have been in defensive sectors such as gold, utilities, and REITs in the portfolio to help stem the decline. So this has worked just like we expected it to. It's reduced the allocation in equities, went into more defensive sectors over time. And so you were well positioned to stem some additional sell-off within your portfolios. Overall, across all of our investment programs, we're seeking to actively capitalize on opportunities presented by the volatile investor sentiment we're seeing, while ensuring that the portfolio risk profile remains appropriate for each specific strategy. We will continue to make additional changes as warranted, including opportunistically rebalancing the portfolios. Remember, as I said in the last slide, when this market volatility will start to decline is really highly dependent on when that rate of infection starts to slow globally. And so we are watching that very, very closely. Now, overall, we've always maintained that predicting market movements is not easy. Many of the measures that have been put into effect by national, state, and local governments have had a severe economic impact. In the short term, it's likely affecting all of you in the short term as well. However, we do see well-capitalized companies being impacted in these sell-offs, and we see great opportunities for them over the long term. And so we are staying the course in those companies because we do believe that they will come out of the other side. And we know that these times are difficult for you, but we encourage you once again to remain committed to your financial plans that were made during more rational times. As always, if you have any questions for us, please reach out to us. And most of all, be safe. Thanks.